about 22 years now. I'm starting to feel old, and I'm starting to feel old at real estate too. This year will be my 20th year as far as being a property owner. I started buying properties at the age of 23 after I got into the mortgage business. And this presentation is going to kind of speak about what I did when I first started, how my strategy was good, bad, and otherwise, and how it's changed since then. But for those who are joining on the other platforms that we're up on, we are speaking today about how I built a real estate portfolio over the last 20 years and the good and bad and ugly of it. So, over 20 years of real estate, I have succeeded and failed, right? I got into mortgages in about 2002, and I rode that wave till about 2008. And when the market crashed, my strategy, and by the way, anybody who has questions, drop them in the chat. If you have questions along the way, just let me know and I'll try to answer them as we go. So if you have questions on anything I'm saying or something comes up from what I'm saying, just drop them in the chat and I will answer as many as I can. So I rode the wave from 2003 to 2008 as far as buying properties. But when I first got into buying properties, I didn't know what I was doing. The first property I ever bought, I know there's some people on here that I've spoken to before that have done some of the same things where they bought a multifamily first. So I was born and raised in New York. And a big thing in New York is multifamily properties, small multifamily properties, 1 to 4 family. If you're starting a real estate portfolio, in my opinion, no matter where you are, the best thing to start with is something that's income producing that you live at. So that's how I started. I started buying properties at 23 with a 2-family property that I had bought with my brother. And that property was something that we lived in and that we also rented. So a lot of the rent covered what I was spending monthly on the house. And that's why I think it's the best way to start. Today's the first day, and you're going to buy a property and you ask, what would I do first? That's what I would do first. It's the least risky way to start buying real estate. It's the most affordable. For those who are in America, and I'm sure in Canada and India, there's some programs like this too. FHA financing allows you to buy a 1 to 4 family property with 3.5% down. As long as it's owner occupied, meaning as long as you live there. That's how I would always start everything. And multifamily properties are still about 50% of what my portfolio is today, because it is the least risky proposition when you're buying a property, because anything that's income producing, that's a long-term lease. And I'll get into some short-term stuff later on, but a long-term rental property is something, as long as you can keep it long-term, you will most likely be up on. So that's how I started. I sold that property in 2005 for a pretty big gain. And then I started making some mistakes, right? I thought I knew too much. I wasn't asking around too much. There wasn't stuff like this available to me. At least I didn't think at the time, where I could go ask people questions on what I should do next. Roshni, I'm still a mortgage person. I run a mortgage company, Cardinal Financial. We're in about 9 states in the United States. So I'm still in it, and I run my own real estate portfolio, which to date is somewhere between 25 and 30 million today. That's probably where it's worth, depending on the market and what those properties are worth. But that's what I have left, and that's what I'm doing today. So that's what I'm still doing. So the mistake I started to make, and this is kind of where we'll start to get into what you should do and not do, right? There was a trend that was very, very popular then that's not popular now, but sometimes you jump on trends, and trends aren't the best way to kind of function in a market. And the trend at that point in certain markets, and let me start here actually. The difference between the market that crashed in 2008 today, right? I know a lot of people are scared about investing in real estate or being in real estate and what's going to happen, and banks are crashing. The biggest difference between that market and this market is this. There was an abundance of houses available in 2006 and 2007. There was building being done all over the place. We had an excess of homes for sale, meaning we had too many. We had more than the average that the country needed at that time for homes for sale. Right now, and for the last 3 or 4 years, longer than that, since pre-COVID, we have been in an inventory shortage, meaning that there's not enough homes for sale in this country. So there's not enough homes available on the market to create any kind of market crash. Also, what caused the crash in 2008, and I've explained this in other places, and if anybody's ever watched The Big Short, It's a great movie to watch to understand it. But what really happened is that Wall Street firms started packaging up mortgage-backed securities. So they started saying, hey, we have 1,000 mortgages. We're going to create a bond out of those mortgage securities. And when you have a bond, that bond gets rated by pretty much two agencies, Standard & Poor's and Moody's. They're going to rate that bond AAA, AA, single A, B, C, or D, right? That's how bonds get rated. AAA obviously being the best. They were taking these mortgage-backed securities and rating them all AAA. Every single security at the time was rated AAA. What people started to realize around 2005 and 2006 is these AAA rated mortgage-backed securities were not really AAA. They had risky loans in them with bad credit, and the defaults on these subprime and alt-A type loans were very, very high. So stuff was rated at AAA, and they were really C or D bonds. If the bonds were just rated correctly, people would have taken the right risk on to buy those bonds. But people were buying them like they were secure as a AAA bond would be, which basically means your money is safe, and they weren't. So when people started to realize that these bonds were really not good and they could default, they started to short. So they started, for those of you who don't know who it is, they started to bet that they were going to default, that they were going to fail. And then it just created an avalanche of these people starting to bet they were going to fail, and it crashed the market. That doesn't exist today. 80% of the financing that's done on mortgage today in the United States and even in Canada, in order to be the case, is government-backed securities, right? So that they're government-backed loans that are really, really not that risky of loans. So we're not in anywhere near of a market that was dead. But back then, that was the market. And I started to use some of these subprime loans and alt-A financing to buy properties with not a lot of money down. And a trend that I got on that was not smart, and this is what we learned to adjust, was that I was buying pre-construction homes in areas that were being built up very fast. So Florida was being one of those markets in the United States that I was buying in. And I was buying homes that were not built, and they weren't going to be finished for a couple of years. So I was buying a house for $200,000. And before that house was even finished, before I even saw the property, I was selling those houses for between $75,000 and $100,000 profit. So I was buying a house pre-construction and selling the house before it was completed. So this was my strategy. I was like, this is great. I can make money and not really take on any risk, because I didn't even have payments on this financing. I was just signing a contract. And then before the house was finished, I was flipping that contract. So that it's kind of like wholesaling is done today, for those who understand that. But I was taking on all the risk. The loans were in my name. So around 2006 and 2007, when the market started to fail, I got stuck with some of these properties that were pre-construction that weren't finished. So it was really a bad strategy. And I'm going to explain what makes a good strategy and a bad strategy, but it was really a bad strategy because it didn't really allow for any exit, right? This is kind of where I am today. I have over a $20 million portfolio that grosses in excess of $800,000 a year. It took me less than 10 years to build that portfolio, but that was after I failed, right? So I really went through a lot of pain after 2008. I really lost everything. I went from living pretty high I went from living in a penthouse apartment on Wall Street. I was literally on Wall Street, living in a studio apartment that was costing me $700 a month. And I never declared bankruptcy or foreclosed on any of my properties, but I was broke, right? I was really, I lost everything overnight. And it's because I didn't have enough money to sustain my investments, and I had no exit strategy for stuff if the market went bad. So that's kind of where I went from. I went from good to really bad really quick. So to become a successful investor, I believe that you need these three strategies. This is what's important to me now that I learned from my mistakes. This is what I think is important as an investor that you need. This is what you would need, right? Number one, and for anybody that wants this presentation after it's finished, you have my meetup. You're all joined through meetup. Drop me a note. I will send the presentation out. I'm going to send an email out to everybody that signed up for it today, and I'll have the presentation and a recording of this. So if you guys want to watch it again. So the first thing I think you need is a method to buy the right properties based on income potential that is derived from real data. So what do I mean by that? You have to be able to know what your market is and get real data from it. A big strategy right now, and I'll get into this a little bit right now, is 50% of my portfolio right now is short-term rentals or Airbnb and VRBO properties, for those who see that all over the place. With that strategy, right, I have places I can look, like AirDNA is a website that I use. It's airdna.co. if you go at airdna.co and put in the zip code, it actually gives you properties in that zip code, exactly how much they're renting for, what their demand for those properties is, and what the potential growth in that market is. So I can go look at 123 Main Street on AirDNA and say, wow, that property on 123 Main Street in New Jersey made $70,000 last year in rental income on Airbnb VRBO. The good and the bad of Airbnb and VRBO is the data is public knowledge. It's good because you can make a good investment off it. It's bad because in this country, they've learned how to tax you on it more. The cities are now taxing you if you have a short-term rental separately than everything else. But to have a good investment strategy in real estate, you really, really need to be able to pull data that shows you exactly what is renting, right? And again, if you guys have questions along the way, let me know. And if not, I'm going to take questions at the end. So part of the problem I had with my first investment strategy that didn't work is that there was no data on flipping contracts on pre-construction properties. There was just people following a trend. They were buying those properties and selling them. There was no long-term data on that. What I learned from that and what you'll learn from data is that if you look at every single real estate purchase as a long-term investment, meaning like, hey, I can keep this property long-term. If you do that, okay, that's a good question. How would you pull data for long-term rentals? Any realtor that you deal with or with an appraisal on a property is going to give you market rent. Market rent shows you the average rentals for that zip code. I know there's some realtors on there, and I'm sure they can answer to some of that as well, but market rent is going to show you the average rental for property. If you're dealing, you should be using a realtor for if you're buying a property. Ask that realtor to find the market rent for you in that zip code, and they can give you the average rent for those types of properties. So whether it's short-term or long-term, you can find it, okay? I look at every investment as a long-term investment now, and it's because I failed so badly that I did that. I'm going to give you an example of how that's worked to my advantage at this point. How it's worked to my advantage at this point is one of the properties I bought with all my great knowledge in 2005 was a property in Naples, Florida. It was a two-bedroom, two-bathroom condo in a market that was super, super hot. And I had flipped 3 contracts in that market already where I'd gotten the contract and I had sold it before the house was finished. I bought this property pre-construction in 2005. By 2007, the property still was not finished. My purchase price was $225,000. That property, by the time it was finished in 2008, was only worth $80,000. So it was worth $140,000 less than I was paying for it, and it was something I couldn't get out of. I was obligated to my contract at that point. So huge issue, right? That property, I had no choice to keep because I couldn't get rid of it. And it was the only property, unfortunately, after the 2008 market crash that I still owned. I didn't own anything else. The only thing I had is this grand real estate investor was a property that was worth 30% of what I bought it for, right? So I kept the property. And it was a disaster for me a few years because I had no money to pay the mortgage. So then I had to rent it. So I rented the property. I had a bunch of bad tenants, and I have some crazy stories around that. Somebody who got arrested, somebody who was getting stalked. It was one bad rental after one bad renter. In that property, I still own today. So I own it almost 20 years later, 18 years later. I paid it off 3 years ago. I don't have a mortgage on it anymore. That property I looked at this week because I'm going to list it for sale. I'm going to list that property for $375,000. So the reason I bring that up is because it was a disaster. It was worth $80,000 at that point. But I mean, I don't suggest anybody have a plan that's 20 years out, right? But 20 years later, almost 20 years later, it's going to be 16, 17 years later, I'm going to make my money on that property. So if I just really went into that investment and say, hey, I'm buying this property for $220,000, I know I can rent it for $2,000 a month. That $2,000 a month covers my monthly mortgage at the very least, and I make a little bit amount of money. I'm going to keep this property long term. That would have been the proper strategy, and it would have been fine. But that's not how I was looking at it, right? So I suffered for a long time with the wrong strategy for that property. So that's kind of what I mean about as long as you look at stuff long term, that you can make it work. Number 2, as far as the things I feel like you need to invest, is a tested formula that gives you how much to invest, the potential rate of return, and how long it will take to get your investment back. Now, so what do I mean by all this, right? So what I first mean by all this is a tested formula that gives you how much you should invest. So when I look at my income per year and what I have in the bank, how much can I risk and how much am I willing to sacrifice to buy a property, right? So let's say I'm going to buy my first home when it's a 2-family home and I'm going to put 3.5% down plus closing costs. That's going to cost me $25,000. So my initial investment is $25,000. After my initial investment, I'm going to add in furniture and anything it takes me to set the house up, right? So let's say I'm into the house for $30,000. So that's my investment. I personally want to make between 10 and 15% a year on my invested money. So whether I'm investing in real estate, in stocks, in index funds, in cryptocurrency, whatever I'm investing in, right? I want to make between 10 and 15% return on my money, just for a frame of reference. The best investor in history is considered Warren Buffett, or at least one of them, right? Depending on who you talk to. His lifetime return on his investment at the end of last year, which I believe was 12%. So the best investor in history only makes 12% on his money over 70 years, right? So if I can make between 10 and 50% on my investment, so on a $30,000 investment, that means that I want to make between $3,000 and $4,500 a year back on my money. That's it, right? And then I want to know how long it's going to take me back. So if I'm making, let's say I'm going to make on the low end of it, $3,000 a year, my investment is 10 years. My investment is going to take me 10 years to get my initial investment back if I make $3,000 per year. I personally really want to have my investment back on any real estate I buy in 5 to 7 years. That's been a tried and proven strategy for me, that I want to have my initial investment back in 5 to 7 years. So if it was a $30,000 investment, right, and I want to have it back, let's say in 7 years, I'm going to need to make $4,000 a year on that investment to get it back, $4,200 a year to get it back. So I know we see a lot of stuff through social media and everybody sells courses and everybody does this. And if you can make 10 to 15% on your money as an investor, you're doing amazing. There's tax benefits to owning real estate. It's a great long-term investment for equity buy, but that's all I'm looking to make, right? That's all you should look at to make. So to make $4,000 a year on a property, right, I need to make essentially not very much money, right? I need to make like $400 a month, $380 a month. That's all. So after my mortgage, my taxes, my insurance, my electric, my anything repairs that goes into the property, that's what I'm looking to make, right? So that's a good, in over 20 years, I've learned that's a good investment strategy. Sure, it's great if you can make 30%, but there aren't that many people doing it. If anybody's telling you they're doing it, I don't know if they're being completely honest with you what it took to make that money. So that's what I'm looking to make, between 10 and 50% of money. And that's number 2. Number 3, and this may be the most important thing I can give you guys, is what is your exit strategy? In case number 1 and number 2 don't yield the right investment, how can you get your money back or get out of that investment without any pain? You should go into every single investment having some kind of exit strategy. Roshi, how is this event helped you or benefit you? What event are you speaking about? Just give me some clarification on that and I'll answer you. So what is an exit strategy? An exit strategy for buying real estate is I can sell the property, I can refinance the property, or I can rent the property to cover all my expenses. So let's say you're buying a single family property for you, right? It doesn't matter. You still have to have an exit strategy. Am I buying this property too high and I'm not going to be able to get out of it? Can I refinance this property? Will this property have equity? My worst case scenario, and this is what I would use on every single property you buy with real estate. If I can't pay the mortgage on this property and I have to move out, can I rent this property and cover my expenses? So my expenses for this property in total of $3,000 a month. If I'm going to get rid of this property, right, and I can't live here anymore, and I'm not going to be able to sell it, I'm not going to be able to refinance it to lower my payment, can I rent this property and cover all my expenses? And that becomes the most important thing. That's an exit strategy. When I had the property in Naples, Florida, and it was just finished, I couldn't sell it, I couldn't refinance it, I had to rent it. I was renting that property for a loss every single month. I wasn't even making any money on it. So that's not a good property. There was no exit strategy. There was no way to get out of it. There was nothing for me to do. So I basically just lost money every month. And as a matter of fact, I gave you some good stats at the beginning of it. Not only was losing money on every single month, it was a condo and I couldn't pay my maintenance fees on the condo because I didn't have any money. I was losing money on the rent every single month. So what ended up happening with this property is that it went into what's called receivership, which means that somebody collected the rent for me and they paid down what I owed the condo association with that money. That person ended up becoming my property manager, so it ended up working out for me. But because he's been very, very good for me. But I went into receivership, so I was, the worst real estate investor of all time at that point, right? But I learned a lot from it. So number 3, and maybe one of the most important things I'm going to give you guys is, what is your exit strategy? Like, you have to have one on every single property. It's the most important thing you can do. So, hey, Ralph, do you utilize a cost segregation study within initial? Yep. Pat, that's a really, really good question. So Pat's asking about cost segregation. So cost segregation, for those of you in the United States, is a tax procedure, basically, where you can take 100% bonus depreciation on your property. So this is something you should speak to an accountant about. But thank you. I've seen some people on Instagram. Again, if you guys have questions on Instagram, just let me know and I'll try to answer all I can. But thank you for stopping in. Bonus, you basically, can you depreciate your property for the full amount that it would be depreciated over 30 years, and take that depreciation expense in the first year. And after that, you're still able to depreciate the property, just not as much as you would in the past. But it could be a 30, 40, 50, $60,000 tax benefit in your first year. So cost segregation is a great tax strategy, but I would speak to an accountant about how you do it. And Pat, I do use cost segregation. I try to use it when I have a tax debt. When I know I'm going to owe money, I go back and do cost segregation on a property to make up for some of that debt. Lower that liability. Yeah, exactly. So how do I scale from zero to long-term wealth, right? So I'm going to give you guys the strategies now. How do you scale from zero properties to long-term wealth? So, hey, Kayla, is the property sold prior to 30 years? Do you have to pay the money back? No, you don't have to pay the money back up front. But if you depreciated the asset, it could be counted towards your capital gains. So again, it's something you talk to an accountant back. And guys, just so you know, when you sell a property, if you sell a property for a profit, in the United States, you have to pay capital gains tax, right? Which could be as much, depending on what your tax bracket is 30%. So if I made $100,000, it could be as much as 30% on that money. So you could have to pay $30,000 back to the government. If you take that money and do a 1031 exchange, meaning that you take your profit and put the profit into another property, then you avoid the tax liability. You kind of pass it down the road. If you take that profit from if you sell a primary residence and buy another primary residence for that property, you don't have to pay capital gains taxes. But hey, in that situation, cost segregation, that bonus depreciation you took, it's going to be added to the value of the property. So it could be a tax liability if you don't use that money to do something else with it. Wait, let me go back. Sorry, guys. So this is how I feel like these are the 3 strategies I would use to get yourself from zero to building a portfolio. Number 1, have a conservative, low overhead, low risk initial investment that allows you to learn, adapt, adjust, and plan better. If I would have just bought the multifamily property I had, right, that I was earning on as well as renting, right, and if I would have just kept that as my baseline instead of selling it and taking the profit and putting it into a risky strategy, I could have done very, very well, and I would have been able to get through the real estate crash without too much pain. I'll give you guys a stat that I think is the best stat I can give anybody who's a real estate investor ever. In the worst real estate market of all time, in 2007, 2008, 2009, right, real estate market crash, worst market of all time, foreclosures, bankruptcies, all the stuff. You know what still went up? Rent. The cost of rent did not come down during the real estate market crash of 2008, 2009. If you were a landlord who had renters, your profit actually went up and not down. Actually, I have an accountant who's my cousin on Instagram right now, and depreciation recapture is ordinary income. So yes, Kayla, any kind of depreciation recapture will be looked at as ordinary income. So you got to figure out something to do with that money after you come back. Thanks, Joe. So having a conservative, low overhead, low risk initial investment allows you to learn, adapt, adjust, and plan better. What I should have done, and what I would do over again, if I was starting over again, I would have taken that 2-family property that I was living in. I would have then rented the other unit, and I would have gone and used a second FHA loan, Or I would put 5% down on a conventional loan. If I couldn't use an FHA loan, you may not be able to use an FHA loan twice. So if I couldn't use an FHA loan, and a surefire way to use a 3.5% down twice is to buy a multifamily first and to buy a single family second. If you're going from a multifamily property, so a 2, 3, or 4 family, to a single family property, you can use the FHA program twice and put 3.5% down twice. So I would have rented both units. I would have then bought a single family property with 3.5% down again. I would have lived in that property for 12 months. You have to live for at least 12 months. I would have then rented that property and then bought another property with 5% down on a conventional loan as my owner-occupied property. Lived there for a year again and did the same thing over again. You can buy 3 to 4 properties with between 3.5% and 10% down. I could buy 3 properties as my primary residence, and after that, I can buy a second home. A second home you can buy with 10% down, right? A second home has to be a property that's in a vacation area or that's a certain amount of distance from your house. A second home can be used as an Airbnb or VRBO property, even if you use it as a second home yourself. You're allowed under underwriting guidelines through Fannie Mae and Freddie Mac, right, with 10% down, to use that property as a short-term rental as long as it's not rented, as long as it doesn't have a long-term lease. A long-term lease is considered anything that's 30 days or over. So you can actually buy 4 properties with between 3.5% and 10% down. And I think that's really, really important. And if I was to start over again today, right? If today was my first day buying a property, that's what I would do. I would FHA loan, 5% down conventional loan, 10% down second home. That would be my first 4 properties. And today I have 6 multifamily properties today. Those properties don't make a tremendous amount of money a year. I would say the average between 10 and 50% gain on my income a year. That's it. That's all they're making. But long-term, they're great assets. They're long-term great assets because people in your lifetime will always want to buy income-reducing properties. It's a property that always has an exit strategy, right? Unless the property's in disrepair or something else happens. But for the most part, it's always something. So that would be number 1. Number 2 would be take advantage of dips or opportunities in the market. That doesn't mean jumping on trends, but basing opportunities on historical upsides. All right, guys. So what do I mean by that? It's tough right now, if I'm being completely honest with you, to find a huge dip in the market, right? Because we have a shortage of inventory and stuff is selling for high. There's bidding wars, all that stuff is going on still. So it's tough to find a dip in the market right now, but that doesn't mean there's not opportunities. I'm going to tell you where I think there's opportunities to buy in this market today. So the thing I'm seeing as a mortgage lender, where people coming to me to either refinance or buy a property, whatever it is the market that are suffering right now are, number 1, investors who bought properties to flip them and either couldn't finish the property or paid too much for the property when they bought it. And most investors that flip properties, so they buy the property, they rehab the property, and they try to sell the property in less than a year for a profit. Most of them are going from project to project to project. They don't have a huge amount of capital. So to get to the next project, they have to sell their current project. I'm seeing a lot of those guys come back to me that bought in somewhat tougher markets. So what I mean by tougher markets, lower end markets, Newark, New Jersey, Baltimore, Maryland, Philadelphia, Pennsylvania, areas that you could buy properties for lower end and you can flip and make between $50,000 and $100,000 profit. Those landlords or owners of those properties are having a hard time right now. I've had a lot of them come back to me to try to refinance, and I can't refinance them because the property's not worth what they bought it for because they overpaid a little bit, and they can't get their money back. So that's one opportunity I see in those markets. The second opportunity I'm seeing right now is in vacation markets. There's a lot of opportunity in vacation markets because what happens, real estate's not down, but what happens in recessions or down markets or high inflation markets when people lose money? They start to liquidate things that they don't need every single day. You don't need the second home every single day. If you have a primary residence you live in, you don't need a vacation every single day. I'm seeing vacation home areas, there be a dip in the prices in those markets. And for those of you from New Jersey, from New York, I own a property in Seabright, New Jersey. It's a multifamily property. It took me 2 years to buy that property. because the market was so hot. It's a small area. Properties only come on a couple of times a month. There's probably 30 houses for sale in the whole entire market. It took me 2 years to buy a property in the market because I kept getting outbid. I couldn't get anything. Over the last 3 months, I've seen 3 times the amount of properties come on in that market than I saw when I was trying to buy. And that's because people getting rid of their, and that doesn't mean it's not a good place to buy. And I'll tell you why it's a good place to buy. I bought a property there for, it was expensive. It was a $1 million 2-family property. That property I bought in the beginning of 2020. Conservatively, that property is worth somewhere between 1.6 and 1.7 million at this point. And that's, I'm not looking to sell it. That property is an Airbnb, a short-term rental property, made, it's gross income, not net profit. Its gross income in that property was $140,000 last year. So I don't want, people are still going to rent, right? I said rent went up in the worst market in history. People are still going to rent. So it's not a property I want to sell, but this property is coming on in that market for lower prices than they were last year because it's, people are accessing. So those are the 2 places I see dips. The other place you're going to see a huge opportunity, in my opinion, is in the commercial market over the next 12 to 15 months. Commercial mortgages, a lot of times, are only a 5 to 10 year term. So what does that mean? That means a lot of these commercial properties that were bought and or refinanced will and here's the other thing. Not only are they shorter terms, but a lot of times they're adjustable rate mortgages. They're 3 to 5 to 7 year adjustable rate mortgages. A lot of those mortgages will come due this year and next year, meaning that these people either bought or refinanced these properties between 2 and 3% interest rates. Those interest rates are now going to be double. A lot of these commercial landowners are not going to be able to keep those properties. They're going to have to sell. There's going to be an opportunity in the commercial market to buy. So that's the third market I see an opportunity. The other thing you're seeing in the commercial market is this office space obviously doesn't have the same demand as it did in the past. A lot of those office spaces are now turning into residential homes. It's a trend to look out for these office parks turning into residential homes. So those are the 4 opportunities that I'm seeing in the market right now. What I mean by not jumping on trends. So Airbnb is a good example. I've bought a lot of Airbnb properties the last couple of years. What I'm seeing in that market right now, because it was a trend, right? All these people making money in Airbnb markets. I think it's a great place to be for me right now. But if I didn't have money to sustain that property in case it didn't rent, it could become a problem for me. What I'm seeing in some markets is that a lot of the homes that were listed in the last 12 to 24 months are coming off the market because the owners can't afford if they have somebody who doesn't rent that month. So there's going to be opportunities in those markets to buy, but there's also that's a trend, right? People, they didn't have a long-term strategy for that property. They just thought, oh, I'm buying an Airbnb and it's going to be great. And some people bought during COVID, and the rents that you got during COVID are not the same as they are now because people were renting vacation properties for months, 2 months, 3 months. Now people aren't doing that anymore in certain areas. So it's becoming a problem. So like I said, you don't want to necessarily jump on the hot trend as a long-term strategy. You need to have an exit strategy long-term. You don't want to jump. And then number 3 would be use your assets to make more assets. Leverage your properties with the right financing and exit strategy. A lot of people that work for me, and I think some of them are on for them right now, I know Denise is on, and I know Vicky's on, they've bought multifamily properties. They've refinanced those multifamily properties, taken cash out, bought more multifamily properties, bought vacation homes. They've leveraged their asset to create more assets. The reason why I like Airbnb and short-term rentals is because I make more per month on those properties than I make on my long-term lease. So anything over 30 days, multifamily properties. So I can make between 20 and 25% on my money with those Airbnb properties. I'm using that income to buy more Airbnb properties. So you have to use your asset to create more assets, right? So that's the other thing that I would look at if I was trying to leverage my property to create more, right? Does anybody have any questions right now about financing or about strategies or about, so we're getting towards the end of the presentation. So does anybody want to drop any questions they may have right now? I have a question on Instagram. Does having a real estate license help you become more knowledgeable? I think absolutely. Yeah, I think as a real estate agent, you have access to data and people and information that you wouldn't have it if you weren't a real estate agent. So yes, I think becoming a real estate agent definitely helps with investing. Any questions, guys? Anybody who's specifically interested in short-term rentals or Airbnb buying? Hey, Denise. I have a question for the 1031 exchange. Let's say I need 100K on property. I only use 50K to buy another home. Do I still need? Yes. Denise, not only do you have to use the money from the property you sell to not only do you have to put the profit into a new property, you have to put whatever equity you have into a new property. So if I bought a house for $300,000 and I sell it for $500,000, I have to put that $200,000 in plus whatever my down payment was. So let's say on that $300,000 home, you put 20% down, right? So that's another $60,000. You have to put $260,000 into another property, or you have to pay taxes on whatever you didn't put into it. And here's the thing about 1031 exchanges, guys, too, and it's very, very important to know. You have 6 months to use that money from the property you bought to put into another property, right? So you have 6 months to use that money, or you have to pay taxes on it. But what's more important is you only have 60 days to identify that property that you're going to buy. So I just went through this, right? I only had 2 months to find the property from my close date to when I actually bought the property. That can be stressful. So before you sell a property, if you're going to do a 1031 exchange, have in mind what you're going to do with the money right up front, or you're going to pay taxes on it. So Denise, you just have to look at that, right? You have to look at what makes sense, what you can net out of it, but you're going to pay taxes. You're going to pay taxes on just profit, though. You have to put all the money in, but you're going to pay taxes on just the profit, not on the money you put into it. Any other questions? Can use money on more than one? Can use them? Yeah, you can. But you can use that 1031 exchange money on more than one property, but you have to identify those properties within 60 days. And for that stuff, everybody, there's specific 1031 exchange companies that do this for you. So you have to contact them before you sell the property. They take the money. Yes. No, you don't have to be under contract, Denise, but you have a list, right? You have to give your 1031 exchange company a list of your 3 property addresses that they then will file with the IRS. Those 3 property addresses, you have to buy one of those properties. So in 60 days, you have to put 3 addresses on a piece of paper. You have to give that paper to the 1031 exchange company, then give it to the IRS. You have to buy one of those 3 properties, or all 3 of those properties, to be able to use the money. I got another question on Instagram. Do you prefer short-term rentals or long-term rentals? I prefer both. I think it's good to diversify. If I was to buy one property today, if I was trying to have the most surefire way to make money over long term, I would buy a multifamily property. I would buy something that was I could live in and collect rent on. That's the safest way to buy your first property. As I got more properties, I would start investing in short or Airbnb or short-term rental properties. Anybody else have questions? Don't be shy. And if you want to unmute and ask me, you can do that as well. Or if you just want to ask in the chat, however you'd like to ask, just let me know. I'm going to, if you can't unmute yourself, just let me know as well.
Hey, Ralph, Sal here.
What's up, Sal?
Hey, man, thanks for this. This is awesome. So, I just finally listed my first short-term rental in January. It is a ski resort area, but there is a lot of summertime activities. We were running hot with bookings as soon as we like January and February were amazing months. Okay. And then March was like, April is pretty bad. And I'm well aware that you got to stay in for at least 12 months to understand, how it goes, right? So I'm not in a state of panic at all. Plus, my family and I have been enjoying the place, which is a great byproduct, right?
Yeah.
But with your, with as many properties as you have you noticed a decrease in bookings that you could say is due to Airbnb? Like, should I be going on and maybe rewording my listing and stuff like that? What do you think there?
It's a good question. So you always should be tweaking it, right? The most important thing is to always be looking at your prices, because like I've had properties that'll sit for 2 or 3 weeks, and then I go look, and it's because my house compared to the rest of the houses in the area is just priced too high. That happens a lot. And as soon as I adjust the price, boom, I get a booking. But the thing that's most important from what you ask is I've had a lot of my properties 2 years at this point now. So I have a really, really good gauge. I can tell you that my overall income is up this year on almost everything, on everything basically. I would say 90 to 95% of them compared to last year. So I haven't seen a trend down yet overall from what they were last year to this year. Now that could be due to a couple of things too, Sal. There's other factors, right? It is how many reviews do I have, right? Because I had a Miami property that couldn't get rented for the life of me. And then I got like 4 or 5 reviews, good reviews, and then it started renting really, really good. I actually just rented it on PeerSpace today for, and PeerSpace, just for you guys who have short-term rentals, is renting your house for photo shoots, video shoots, events, business meetings, stuff like that. It's a great, PeerSpace is a great place besides Airbnb or be able to rent. I just rented it on PeerSpace for the Love and Hip Hop show, which I don't watch, but they gave me a 10-month contract at $3,000 a day. So it's it's property changing, but it's because I had good reviews. So I think reviews are a really, really good portion of it too. But I haven't seen a trend down on my properties this year yet. But I didn't really know the properties at all until I had 12 months, until I had a significant amount of reviews. Because the more reviews you have, the further you show towards the top of the page on Airbnb. Airbnb runs on an algorithm now that if you don't have a lot of reviews, after the first 30 days, you don't show up a lot. So the more reviews you can get, it's really, really important that every single person that stays there. And Sal, another thing I do that's really, really helpful is that after somebody stays, if my cleaner says they left the house in good condition, I immediately message them and say, hey, cleaner said you guys were great. We'd love to have you back. Here's a 10% discount. And I start to get a lot of repeat guests if they were a good guest. And then they leave a review. So that's a really, really good idea to use as far as Airbnb goes.
Nice, thanks. That's helpful. I think I'm trending well in all those areas, reviews and whatnot. The only thing I haven't done is play with the wording and the pricing. So
Yeah.
I'm gonna do that
And you
today.
have
So thanks.
I've seen your listing. You have great pictures. I think you did a really good job with the listing. I really do. But it's definitely an ever-changing process where I think we have to examine it over and over again.
Yep, that's the only thing I haven't done. So thank you.
No problem. Somebody asked me on Instagram, if you have 4 houses, is it better to live in one or is it to rent? I think that's a really good question. I always feel like it's better to live in one of the properties and live as free as you can. If you can live in a property and rent it at the same time and live as free as you can, or maybe you can't, but I always feel like it's better to try to live in one of the properties for tax purposes. At the end of the year, if you live in your property, you can write off your mortgage interest and you can write off your property taxes. If you don't live there, the deduction is much less. The largest deduction on any of your homes is the property you live in. I saw another question. What is the name of that program again? What program were you asking about? I probably said something and then I forgot about it. Any more questions here? And guys, if anybody's interested, there's a couple of people actually who are in my program, Sal and Rocky. If anybody's interested in my Airbnb course, it's $795 right now. It's the next realist. I'm sorry. If you go to my website, ralphdbugnara.com, it's right on my website. So if anybody's interested in exactly how we set up the Airbnbs and how the technology we use and all that other stuff, it's right on ralphdbugnara.com, and the course is $795. So if anybody's interested in that, it's available. It's right on my website. You can get it there. $797 actually. Any more questions from anybody? If not, I'm going to wrap it up, and I will send this recording out to everybody, and I will send out the PowerPoint. If anybody that's on Instagram that stayed on all this time, I appreciate it. If you guys want the PowerPoint of the recording to this, just send me a DM and I will send it out to you. Thank you, everybody. I appreciate you guys coming. Hopefully you come to the next video. We're going to keep doing things on Meetup, so just look out for stuff on Meetup as far as real estate investing and stuff we're using to invest in today. Thank you, everybody.
Thanks, Ralph.
Take care, guys.